What's up, everybody? It's David. I know getting started in the world of investing can be super intimidating. You've got all these terms being thrown around, different strategies, and of course the fear of losing your hard-earned cash. But let me tell you, investing is one of the most powerful tools you have to build long-term wealth. Today, we're breaking it all down, simple and straightforward, in our beginner's guide to investing strategies. Whether you've got a few $100 or a few thousand to invest, we'll cover the basics you need to know to start growing your money. So grab your notepad, get comfy, and let's dive right in. Alright, let's kick things off with a strategy that's perfect for beginners' long-term investing. This approach is not just for those new to investing, but also for anyone looking to build wealth steadily over time. Think of this as planting a tree. You start with a small seed, and with time, care, and patience, it grows into something substantial. You wouldn't dig it up every week to see if it's grown, right? The same principle applies to your investments. Same goes for your investments. Constantly checking and worrying about short-term fluctuations can be counterproductive. With long-term investing, you're focusing on high-quality companies or index funds that you believe have solid growth potential over a long period. This means doing your research and choosing wisely. The key here is to ride out the ups and downs of the market. There will be times when the market dips, but don't let that scare you. See, the market is like a roller coaster. There will be dips and spikes. It's all part of the journey. But over the long haul, the overall trend of the market has historically been upwards. This is why patience is so crucial. By staying invested and not panicking when things get bumpy, you're giving your investments time to grow. Remember, time in the market beats timing the market. One of the easiest ways to get started with long-term investing is through dollar-cost averaging. This involves regularly investing a fixed amount of money, regardless of market conditions. This strategy helps to reduce the impact of market volatility. By spreading out your investments, you lower the risk of making a poor investment at the wrong time. The bottom line is, long-term investing is about patience and consistency. Stick with it, and over time, you'll likely see your investments grow. Next up, we've got value investing, a strategy favored by legendary investors like Warren Buffett. This approach is all about finding stocks that the market has overlooked or undervalued. In a nutshell, value investing is like hunting for hidden gems. You're on the lookout for stocks that are trading for less than their intrinsic value. You're looking for stocks that are undervalued by the market, meaning their stock price is lower than what the company's actual worth is. This discrepancy can be due to various reasons, such as market overreactions or short-term issues. It's like finding a designer watch on sale. It's still a great watch, just priced lower than it should be. The key is recognizing the true value behind the price tag. Now, how do you find these undervalued companies? You gotta do your homework. This means diving deep into financial statements, understanding the business model, and evaluating the management team. Look for companies with strong fundamentals, meaning they have a solid track record of profitability, low debt, and consistent cash flow. These indicators suggest a stable and potentially profitable investment. These are signs of a healthy business that might be overlooked by the market. Sometimes the market's short-term focus can miss the long-term potential of a company. Value investors also focus on companies with a competitive advantage. This could be a unique product, a strong brand, or a dominant market position. The key takeaway here is that value investing requires patience and a long-term perspective. It's not about quick gains, but about steady growth over time. So, if you're willing to put in the research and have the discipline to stick with your picks, value investing could be a profitable strategy for you. Remember, it's about finding value where others don't see it and having the conviction to hold on for the long haul. Now, if you're feeling a bit more adventurous and have a higher risk tolerance, growth investing might be up your alley. This strategy is all about finding companies with high growth potential, even if their current valuations seem a bit steep. Think of it like investing in a startup. Growth investors typically focus on sectors that are expected to experience rapid growth, like technology, healthcare, or renewable energy. These companies are often disruptors, developing innovative products and services that are changing the game. Now, it's important to note that growth investing can be volatile. Look for companies with a strong management team, a clear vision for the future, and a large potential market for their products or services. Growth investing isn't for the faint of heart, but if you're willing to stomach the volatility and do your research, it could lead to significant returns over the long run. Chapter 4. The gift that keeps on giving. Dividend investing. Alright, let's switch gears to a strategy that's perfect for income-focused investors, dividend investing. This approach is particularly appealing for those who want a steady stream of income without having to sell their stocks. This is all about investing in companies that pay out a portion of their profits to shareholders in the form of dividends. These payments can be a reliable source of income, especially during market downturns. Think of it like getting paid to own a stock. It's a way to earn money simply by holding onto your investments. Now, not all companies pay dividends. It's a practice more common among established, profitable companies that have extra cash flow and a stable financial foundation. These companies often have a long track record of success and are in a position to share their profits with shareholders. Dividend investing is a great way to generate passive income from your investments. This can be particularly beneficial for retirees or anyone looking to supplement their income. You can choose to receive those dividend payments in cash, or you can reinvest them to buy more shares and accelerate your returns. Reinvesting dividends can significantly boost your portfolio's growth over time. When looking for dividend stocks, it's important to focus on companies with a history of paying consistent and growing dividends. This indicates a company's financial health and commitment to returning value to shareholders. So, if you're looking for a way to generate passive income and potentially live off your investments one day, dividend investing could be a great option for you. It's a strategy that rewards patience and long-term thinking. Chapter 5. Timing the market sector rotation. Now, for those of you who like to analyze market trends, sector rotation might be a strategy to explore. This involves shifting your investments to different sectors of the economy based on which sectors are expected to perform well in the current economic cycle. Think of it like this. When the economy is booming, sectors like consumer discretionary, technology, and industrials tend to do well. But when the economy slows down, sectors like consumer staples, healthcare, and utilities might hold up better. Sector rotation requires you to stay informed about economic indicators, interest rate changes, and government policies that could impact different sectors. However, if you're comfortable with the risks and have the time to dedicate to research, sector rotation can be a way to potentially outperform the market. Chapter 6. Don't put all your eggs in one basket. Risk management. Listen, no matter what investing strategy you choose, risk management should be at the forefront of your mind. Remember, investing always involves some level of risk, and it's impossible to predict the market with 100% accuracy. So, how do you manage risk? The golden rule is diversification. Don't put all your eggs in one basket. Instead, spread your investments across different sectors, asset classes like stocks, bonds, and real estate, and even geographies. This way, if one investment performs poorly, it won't completely wipe out your entire portfolio. Another important risk management tool is using stop-loss orders. And finally, never invest more than you can afford to lose. Alright, I can't stress this enough. Staying informed is crucial in the world of investing. The more you know, the better equipped you'll be to make smart investment decisions. So, how do you stay in the loop? Make it a habit to read financial news, follow reputable financial websites and blogs, and listen to podcasts from industry experts. Pay attention to earnings reports of companies you're invested in or considering investing in. These reports give you insights into a company's financial health and future prospects. Keep an eye on economic indicators like inflation, interest rates, and GDP growth. Remember, information is key to making informed investment decisions. Alright, let's talk about the elephant in the room: emotions. See, investing can be an emotional roller coaster. When the market's soaring, it's easy to get caught up in the hype and make impulsive decisions. And when the market crashes, fear can set in, leading to panic selling. But here's the thing: letting your emotions dictate your investment decisions is a recipe for disaster. Remember that long-term investing is a marathon, not a sprint. There will be ups and downs along the way, but it's crucial to stick to your investment plan and avoid making rash decisions based on short-term market fluctuations. One of the best ways to avoid emotional investing is to have a clear investment plan in place. Define your financial goals, risk tolerance, and time horizon. Write it down and refer back to it whenever you're feeling tempted to deviate from your strategy. Listen, I get it, investing can feel overwhelming, especially if you're just starting out. There's so much to learn, and it's easy to feel like you need a finance degree just to understand the basics. If you're feeling lost or unsure about where to start, don't hesitate to seek professional advice from a financial advisor. A good financial advisor can help you create a personalized investment plan based on your specific financial goals, risk tolerance, and time horizon. They can also provide valuable insights and guidance, helping you navigate the complexities of the market. Look for a fiduciary financial advisor. This means they're legally obligated to act in your best interest. Remember, seeking professional advice doesn't mean you're giving up control of your finances. So, there you have it, our beginner's guide to investing strategies. Remember, investing is a journey, not a destination. There will be bumps along the road, but the key is to stay focused on your long-term goals and make informed decisions. Before you jump in, take some time to assess your risk tolerance. And hey, if you're ever unsure about something, don't hesitate to reach out to a financial advisor for personalized guidance. So, what are you waiting for? Start investing in your future today.